understand what it is we do? Well, yeah, you guys sell policies. Wrong. We don't. We teach a process, a very important process of taking back control of your money. And it's a banking process. We teach you how to be the bank. Oh, yeah, that BYOB thing. Yeah, so back to the policy. No. Back to the process, sir. It's the process that's going to change your life. It's the process that's going to make you wealthy. It's the process that's going to keep you wealthy. If you want to buy a policy, let me give you someone else's name, because that isn't us. It isn't us. It's somebody else. We'll set your policy up, but please understand this process is what we care about. The policy just makes your money work a little more efficiently. So that's all right. What's going on, everybody? It's another week, another wealth webinar, and today, oh wow, we got a lot of stuff we can go over. But I thought, when me and Stephen were talking about what we'd talk about today, is I thought, let's take it down to the bare bone basics. You all in the news by now have heard about what's going on with SVB, Silicon Valley Bank, and Republic Bank, and Signature Bank, and Credit Suisse. I mean, you can just, the story just keeps going. The real question is what does this mean to me? Because didn't the government just bail out the banks? Yeah, they bailed out this round, but can they bail out all the rounds? And should they have bailed it out? And what does that mean? We could spend a lot of time going into all of these different things, but in sitting here thinking about it, you can really learn about a lot of that stuff just by watching that YouTube video I did. And we rushed that video out Monday. Jordan stayed till 8 o'clock editing it for all of you. So if you're still questioning what happened, why the banks are starting to suffer, we'll hit a little bit of that. But I thought, let's make this about you. Let's look at what most people are looking at as a bad situation. There's a lot of panic out there, a lot of fear, and that's normal. Hopefully none of you are scared, because hopefully all of you are like, all right, here we go. You guys have been talking about this for over a year. It's finally starting to happen. Let's make some money. Great. Well, let's make some money. So I thought what would be cool is to do kind of a multifaceted training here and show you, first off, how to make money doing exactly what took down SVB. So SVB had some major issues and took some bets on something that didn't pan out, didn't play out, didn't work out, but it's something we've been talking to you about. We trained it heavily on the 3-day virtual training, which any of you that were there, this will be a little bit of a repeat, but it should land. Before it didn't really land, but today it should really land for all of you, because you've heard about it. Now it's become real. And the other thing too, and internally behind these closed walls, this team, we are always talking about, when are we going to get our big break? When is it finally going to happen where people are actually going to start listening to what we're saying and understand that, like, we're not just, just blowing, hot air. We're actually telling you something to get you ready for what will be the biggest opportunity. Now, I know you guys are all our tribe. So, all of you already know, and you're probably not as scared as other people, but there's a lot of people out there that are frightened right now. I mean, look at the news feeds, look at Instagram and TikTok and everything else. It's doom or gloom right now. And well, I don't know, could be, very well could be, but let's do a roll count here. I want to know how many of you are brand new to Wealth Webinar. Put I in the chat. Kind of wanted to see how many newbies we have today. We love our newbies. So we got a couple new people coming in. And the reason I ask that is, we do this every single week. And every single week, sometimes we feel like we're repeating things. But I love it when we get a bunch of new people, because this won't be a repeat for you. And, Christy just said, my people are wondering if SVB events have made HELOCs even more unstable, unpredictable as far as it freezes. Well, we definitely can hit that, Christy. I think that's a very relevant thing to talk about. I think anything when it comes to traditional banks is on the chopping block. And it kind of threw up an alarm earlier. Steve and I do a show every Wednesday morning. It's super fun, called WTF, or What the F. And we had a whole bunch of people throwing around a swear word that I haven't heard in a long time. I actually was glad I hadn't heard about it. But the swear word was CD. We had people saying that swear word. Can you believe it? I mean, come on, man, just drop the F-bomb on me. It'd be a lot better. But when you throw the CD word at me, dude, that's where we got to draw the line. So we're going to talk about some CDs today and why that would probably be one of the worst places. Well, maybe not, but one of the close to at the very top of one of the worst places you could put money. Stephen, do you remember CDs when you were an advisor? We were always up against CDs because it was a higher interest rate cycle back in those days. And what do you remember about CDs? Oh, compact discs. Yeah, those too. I'd rather a compact disc over a CD.
Yeah, I mean, you look at them as like kind of a risk-free place to gain a little bit of interest. I mean, that's kind of the way they've been looked at.
Yep, place where you can give the money to the bank and leave it sit there for 3 years, 5 years. Heck, I even think they got 10 years, and they pay you a very nominal, very low interest rate on your money. And when you do get paid the interest on the money, it's all taxable. So you get a 1099 at the end of the year. And then if something should ever happen and you get to, you graduate a little too early, it's a probatable asset. So we're going to debunk those. I mean, in light of everything going on with banks right now, I think the number one message for today's training, and probably for every training we're ever going to do, is going to be your own bank. Stop giving up control of your money to them, because clearly they don't know how to manage their own damn money. Why would you give them your money to manage? Well, today I'm going to show you how to do what the banks do, but how not to make the mistake the bank made and get caught with your pants down, because it is possible. So I figure let's dive in. Here we go, folks. So I've got it drawn out, and this is not complicated. This is a repeat for some of you, but I updated some of the notes. SVB, Signature Valley Bank. Where did they go wrong? Well, the bank didn't really go wrong doing too much. They were a pretty strong bank for that matter. They had decent assets. They were in the tech space, the venture capital space. They funded a lot of the startups out there. But the problem started with Signature Valley Bank when tech and startups and venture capital started drying up. And you've all seen this. I mean, look at FANG stocks and then trickle down in tech. How's the NASDAQ doing? Not so well. So tech companies are struggling a little bit, and it's just one of those times. It's the end of a technology cycle. It's the end of a short-term debt cycle, and it's the end of a long-term debt cycle. You got all three of these cycles ending. So it makes sense. Well, if the tech stocks and the tech companies aren't doing as well, then obviously we're not going to see as many deposits into a bank that specializes in that. We might also see some more, some loans that are out there that aren't getting paid. So all these things happen with SVB, but that's not the problem. You see, SVB got a ton of money. We did this on WTF this morning. Stephen had a chart, and it showed how much of that money, that $5.1 trillion the government printed, how much of that money actually went to just one bank, SVB. And it was crazy. It was, I'll just draw it out for you here real quick. Actually, I can't, but it was pretty much, it was just like a straight line up. You had pre-COVID or pre-pandemic, and then you had after the pandemic, and how much money flow came into the bank. And that was all printed money. I mean,
just to hit you, we were about $50 billion they were working with for many, many, many years. And then as soon as 2020, they basically like that, and they were playing with about $220 billion of M1 money supply, which is just insane.
Yeah. So, they had a lot of money. They were lending that money out, but when banks have money, they use fractional reserve banking, which means 90% of your deposit they can lend out. They got to keep 10%. But what do the banks do with that 10%? Now we come back to those three bank failures that we just saw. Specifically, let's focus on SVB because they're the biggest. They bought treasury bonds. I mean, makes all the sense in the world for the bank to buy treasury bonds. I mean, they're guaranteed by the full faith and credit of the U.S. government. They pay a decent interest rate, depending on what the times are. Back when SVB was buying them, that was a low interest rate cycle prior to the Fed raising interest rates. They're getting about 1.79%. So how the bank would look at it is, okay, we got this money, this 10%, this tier one capital sitting here. We're going to buy our BOLI, our bank-owned life insurance. So they do that, but then they still got some that's shorter term. So then they got to find a short-term place to put it. So they look at 2-year treasury bonds. And if you've been following SVB, the average duration on their bonds was between 3 and 6 years, which means they had a mix of 2-year and 10-year bonds. But they were averaging about 1.79% on those bonds, which at the time when they bought them, that was probably pretty darn good. Not good by today, because 2-year treasuries are paying 4.2 today. But last year they were only at 1.87. So when they bought those bonds, that's exactly what all banks do. Nothing out of the normal, nothing to see here. This is normal banking business. But where they went wrong is they played a game with the Fed. They took a bet, and that bet was simple, and it was a calculated bet. We're going to basically buy these treasuries, and they bought, just to put things into perspective, I've got the number here. They bought about 100 billion in treasuries. Problem number one, they over leveraged. They took too big of a bet. So they bought 100 billion in treasuries. Now, all of you have followed, like the bank at its peak had 220 billion in total assets. So they took 100 billion of their assets and bought treasury bonds, which means those treasury bonds had a maturity of between 3 and 6 years. Everybody tracking with me? So the bank just said, we won't need this money for about 3 to 6 years. And it was spread out. You know, some were shorter term, some were longer. So if they needed liquidity, they could sell some. So here's what happened. And you all saw this. So this is very easy for you to all comprehend, but I'm explaining this in light of SVB. So I want you to pay attention to how I'm saying things, not so much what I'm saying. I'm explaining this as how SVB screwed up, but I'm also explaining this because I want you to understand how you're not going to screw up and how you're going to make a bunch of money. Because the bank would have done really, really well if, and only if, things had played out just a wee little bit different for that bank. So they bought those treasuries. They didn't think they'd need liquidity because, well, number one, they had their customers making deposits. You know, they would deposit their payroll money. They would deposit their nightly deposits from their business accounts. They would deposit anything. They had their deposits, new deposits every day. But unfortunately, the deposits weren't enough because in the tech industry, they just had less money. So therefore, because they had less, that means less deposits. And then while this is all going down or going on, interest rates started going up. The Fed raised interest rates 7 times last year. Okay, and they raised them once this year, and they're probably going to continue to raise them. Now, that's up for question right now. It's like a coin flip as to whether or not Jerome Powell next week is going to raise rates. Is it going to be 25 basis points? Is it going to be 50 basis points? Or are they going to freeze it, trying to give some stability back to the banking industry, which I think would be a big mistake if they froze it. But let's keep going. As they raise interest rates, now hold on a second. Let me pause. How do you invest money? Can anyone right here, and folks, I'd love this to be the anyone that's new here. Now, some of you are veterans for this show. I mean, we've got about 140 people. A lot of you, have been on this show a lot. So real quick, just the new folks. If you've never been on this show before, can you all tell me what are the 3 most important things you need to understand, as Warren Buffett says, for investing money? Who can tell me? There's 3 things that Warren Buffett says all the time that are key to making money with investments. Just put it right in the chat. Number 1, what must you do to make money with any investment? Number 1, buy low. Okay, sell high. There we go. So buy low. All right, so let's stop there. Michael, great job. Buy low. So we got to buy low. So if interest rates are going up and the Fed is raising interest rates, the one thing that always happens, every financial advisor knows this. So if you've got a financial advisor, I'm kind of questioning why they haven't been talking to you about this, because it's one of the number 1 things taught in the Series 7 exam, the stockbroker exam. When interest rates go up, bond prices go down. Now, what controls the price and how much does the price go down? That's all determined by the duration. 2 years go down less than a 10-year. A 10-year goes down less than a 30-year. So the longer the duration of the bond, the bigger this price decline. But no matter what, if interest rates go up, the price goes down. So right here, right now, what would be a good thing if you were trying to invest smart and you were worried about a potential recession? What would be a really smart thing to buy based on just the information I said right there? If we know interest rates are still going up, and we know when interest rates go up, the price of these bonds goes down, what would make sense? Kind of just gave it to you. Yeah, treasury bonds. It was a trick question, because we want to buy something as the price goes down. Now, banks have been buying treasury bonds. Insurance companies have been gobbling treasury bonds up like crazy because they understand what you're going to hear next. So if we're buying the price when it goes down, we're technically dollar cost averaging low. The problem with Silicon Valley Bank is they bought treasury bonds up here, X marks the spot, somewhere up here, and they could have been higher, but they bought them in 2020 and 2021 before any interest rates went up. We were sitting at some of the lowest interest rate levels back then. So the bonds that they were bought high because we hadn't had interest rates go up. But then interest rates went up. So the price of the bonds went down. No big deal. It's just, we all understand how this works. The bank understood how that works, and you understand how that works, which isn't a problem until your deposits start to dry up. And then once deposits start to dry up, people still are taking withdrawals out. But then one other thing happened, and this was the nail in the coffin for SVB. The news got a hold of it. They heard that this bank, Silicon Valley, needed to raise some money. They were kind of having some money crunches because more withdrawals were being taken out than deposits going in. The bank had its reserves that they could have made, good on those withdrawals, but those reserves were put in these bonds. So the bank then knew, if we sell these bonds here, okay, if we sell the bonds here, we're going to take a significant loss. So their first thing was, okay, well, let's try to raise some money. Let's try to find somebody that potentially could buy this bank. So they started looking at selling, and they started looking at a lot of different things. But somewhere in that mix, they sold those bonds, okay, $2.25 billion worth of bonds, and they took a $1.5 billion loss. Ouch. And they took that loss because out of necessity, they needed the money, they needed liquidity for the withdrawals. Everybody understands that, right? They bought up here, they were getting paid an interest rate of 1.79 average, and they had to sell down here, not because they wanted to, but because they had to, because they needed liquidity. Think of this as, you got money, you bought a stock. And let's just pick on stocks for a second. You bought a stock, and then all of a sudden, like everything, Murphy's Law kicks in, your transmission on your car goes, the furnace at the house goes, and it's -20 outside. Oh, and by the way, your roof is leaking. I mean, doesn't it always come in threes? So your roof's leaking, your furnace is shot, which is a priority, and the transmission in your car, which you need to get to work and bring the kids to school, is gone. But you got the stock over here, but the stock's down 20%. What would you do? Well, would you just say, screw the transmission, screw the furnace, we're going to just freeze and screw the roof? Honey, I can't sell the stock. It's down. No, you would sell the stock. You would take the loss. You would get the money from the stock. You'd fix the furnace, replace the transmission, and repair the roof, right? That's the same thing. That's what SVB did. Like, it's just, that's what they did. And because of that, they were then able to cover the withdrawals. But because news got out that they took this loss, that news got out that they were trying to sell, all hell broke loose. And you had literally not just a withdrawal, you had a good old-fashioned run on the bank. Uh-oh. Well, we thought we had this under control, but now we don't. The run on the bank put them in an insolvent position. It's not that SVB doesn't have the assets. They do. But the assets are not readily available for SVB to get to. So the regulator sees the bank and all's good. Now let's just pretend, okay? And again, remember, don't pay attention to what I'm talking about. Pay attention to kind of how I'm saying, because this could apply to you. Let's just say SVB never needed to sell these bonds, okay? They didn't need that. They didn't have a run on the bank. It was business as usual. The news didn't, I'll be honest with you, did SVB do all things right? No. But did they do a lot of things wrong? Not really. They sort of just did what banks do. The media pretty much perpetuated this whole situation. But now if SVB could have just held these treasuries, SVB knows one thing. Let me just draw a line down the middle here. They know that eventually those bonds would have went back up, or they would have held them to maturity and just got all their money back. This is how insurance companies play this game. This is how I play this game. This is how most banks play the game. And this is how all of you need to consider playing this game, okay? Because it's brilliant, and it's so simple. But your advisor probably won't tell you to do this. No, there's no money in it, sorry. There's no product that they can sell. Hell, you can go buy the bonds yourself. You don't need your financial advisor. You just need to understand what we already went over, which is one side, the X. Price goes down when interest rates go up. Now, eventually, Jerome Powell and the Fed are going to change their tune. They're going to get the economy slowed down. A bunch of people are going to lose their jobs. A bunch of people are going to get laid off. The economy will screech to a halt. We will be deep into a recession, maybe even the next Great Depression. And then all of a sudden, the Fed We'll be like, oh, hey, here we come again. We're going to save the day. We saved the day when inflation was high. We brought it down, didn't we? Woo, we're the champions. Oh, now we got another problem. Oh my gosh, everybody, you guys are in a recession. You guys are suffering. Well, we're going to fix the problem. What we're going to do is we're going to take the lever and we're going to pull it the other way. We're going to bring interest rates down. Instead of raising interest rates, we're going to bring interest rates down. Now, what do you think happens here, folks? When interest rates come down, what do you think happens to price? I mean, I'm kind of doing this like, teaching at almost like a 5th grade level, but I just want you to look here. When interest rates come down, the price of the bonds goes up. So even if you didn't want to hold them for 2 years or 10 years or 30 years, really what you do is you just find a point where you can sell them at a point that was higher than what you bought them at. So right now, if you were to have bought, and I just bought another 100 shares this morning, I'm just telling you what I bought. I bought another 100 shares of 30-year bonds. Okay. So I bought, and I don't know, I didn't get the bottom, but I bought there. I'm just going to wait for the interest rates to go down. And eventually I'm just going to sell and I'm going to make a ton of money, and I'm going to make a ton of money risk-free, because the only risk in this equation, the only risk is that you need your money like SVB did. You have a liquidity call at the wrong time. That is your only risk. It's a timing risk, because these bonds, the 2 years, the 10 years, the 30 years, the I bonds, they're all guaranteed, and I can say that, guaranteed by the full faith and credit of the United States government. So if any of you wanted a great way to make a risk-free return and also be paid, hey, listen, newsflash. We no longer are getting 1.7. We're not getting 1.87 when me and Steven were talking about this last year. Today, 2-year treasury bonds are 4.2%. So not only do you know how you can make a bunch of money in the future, but now you can get paid while doing it, 4.2%. I would suggest not buying the 2 years unless you have a short-term time horizon. I'd suggest the 10 and the 30s. Now, they pay a little less. They pay 3.7 and 3.43. I hope all of you see the comic relief in that. If you didn't, I'm just going to explain it real quick. Does it make sense that a 2-year bond pays you 4.2 when a 30-year bond pays you 3.43? So you got to hold a 30-year bond. You don't have to, but let's just pretend. You got to hold a 30-year bond for 30 years before you get your money back. And you're going to make 3.43 in yield right now. But if I buy a 2-year bond, I only have to hold that 2-year bond for 2 years and I get paid more. I hope all of you understand that's a problem. That's backwards. You should never, ever, ever, ever get paid more for a 2-year bond than you do for a 30-year bond. Come on now, who's writing these rules? It's called the inverted yield curve. It is the single solitary indicator that has predicted every recession since World War II. Precisely 100% of the time. You are now, and we've been talking about this, Stephen, I don't even remember the last time we did this. It was like sometime last year when the yield curve inverted the first time. It was like a flash invert. It happened and then it went back and we're like, whew, I hope that wasn't the sign. And then it happened again and then it came back and I was like, all right, that wasn't the sign. Now, shit, it might be here to stay. So we're now able to make more on a 2-year treasury than we are a 10 or a 30. And all I can tell you is why that happens is the markets, the institutions see more risk in the long term than they do in the short term. Why? Because they see a recession. That is why you can make more on a 2 than a 10 or 30. But I am telling you that you should buy the 10 or the 30 because I don't want you getting excited about 4.2. You already know the banking policies that we do, the whole life policies we do, you can make more than that. Okay. So you shouldn't be excited about 4 or 3. Okay. What you should be excited about is this. When you sell these bonds, when interest rates go down, you will make a boatload of cash. That's why you do this. And, this is just like, when you go to get a sundae, they're like, do you want whipped cream? I shouldn't, but hey, I'll take some whipped cream and give me a cherry on the top. That's the cherry on the top. That's all that is. So right here is how you make a whole bunch of money in the next few years. Risk-free, and you get a cherry and some whipped cream on top of it with the yield. But I would suggest buying 10s and 30 years if you're going to do this. Now, here's why you shouldn't do this. If any of you have the money and you need liquidity of that money, and you might need it for taxes next year, you might need it for a new car, a new transmission, you only got, this is your emergency money that's there in case something happens. And when you have emergency money and you're doing it for something to happen. Something always happens. The transmission, the roof, the furnace. Don't do this with that money because you don't want to end up like SVB. You don't want to have a liquidity need where you have to sell the bonds at the wrong time. This could take a year. It could take 2 years, or it could happen by the end of the year. I don't know. But all I'm telling you is this is what I've been doing with my money for a while. I'm not making a recommendation or a suggestion. I'm not telling any of you you should consult with your silly financial advisor, and they'll probably tell you not to do this because they told you not to do it last year. Why would you ever buy a treasury bond that pays you 1.87% when inflation's at 8? Anyone do that conversation? Did anyone ask your advisor? Did we have anyone last year or even earlier this year ask your advisor what they thought about buying treasury bonds? In the chat, let's hear it. You guys all fired your financial advisors? Good for you. See, we are getting through to them, Stephen. We always think nobody listens, and here they are. They're firing their advisors. So Ethan had mentioned he moved his Army TSP. So if you got a government 457 plan or a TSP plan, you have a fund inside there called the G fund. And guess what G stands for? Government bonds. Guess what government bonds are? These. I wanted to hit this really hard. This isn't the first time I've talked about it. It won't be the last time, but this is probably the only time where I think this stupid, boring strategy will really land home, because I was able to literally show you how this worked against SVB and resulted in the demise of SVB, or at least part of the demise, but how this can result in actually a massive benefit for you. And so let's just specifically focus the questions right now, because we got plenty of time. I'm going to go into, the infinite banking side and how we can do some really cool things there. But I want to just get the questions out on these bonds, because I know some of you are thinking about, all right, yeah, but I don't want to put my money in something that I got to leave there for 30 years or 10 years or even 2 years. So let me go to Ethan's real quick. We were talking about the TSP, and he moved it all to the G fund, which are government bonds. Since I don't have great visibility on the price, I bought when I changed my portfolio. The bond should be highest when the Fed drops the interest rates below what they are now. Correct. So the best thing you're going to do is, folks, if you're going to buy these or do these with your TSP or 457 plan, you don't really need to have too much visibility, because you don't even need to look at your account. You understand how it works. There's fluctuations. I mean, it's not a straight line. There's fluctuations. It goes up one day, down the next, but they're small. All you need to understand is watch the news. Remember why you bought the G fund or why you put money in treasuries. And when you start hearing about the Fed dropping interest rates, or really when you start hearing all your friends complaining that they're losing so much money and they don't know what to do, and their 401k is half of what it used to be and they lost their job, you're getting close. Because when all that stuff starts coming out and you start hearing that from the folks that you are surrounding yourself with, you're going to know that we're really close to the Fed probably changing tune. Because at that point, when people are losing their jobs, the Fed is winning the war against inflation. Because that is the single solitary thing holding this economy up right now is employment. We're all employed. I watched a thing I was running on the treadmill this morning at the gym, and they were talking about why this one guy came on. He was saying, we're going to be the next Great Depression. But then one of the people, the news anchors, was saying, I don't think so. I disagree. And their disagreement was because people are still employed, and there's so much demand for workers. And, until we break the back of America's workforce, we're not going to see a Great Depression or a recession. And the guy said exactly what I'm always saying is, yeah, that's the only thing holding it up. He agreed, but he said, how long is that going to hold when the economy is softening and the economy is getting slower and slower? I mean, do we got any truck drivers on here right now? Railroaders, truck drivers, anyone? Ask a truck driver. Ask them how their loads are. Ask them if they're as busy as they were 6 months ago or a year ago. The answer is no. It's a leading indicator. Transportation is a leading indicator. It will always indicate where we're going before we get there. Real estate, a lagging indicator. So you want to know, you want bad information? Go to a realtor and ask a realtor how everything's going. Is real estate still selling? Are you still going over ask? You're still getting a lot of offers? Well, it's slowed down a little, but yeah, we're still doing well. I don't see that there's going to be any issue. There's so much demand out there. There's no way we're going to see a drop. Lagging indicator, leading, lagging. Trucking is inconvenient last 2 years. I don't know what inconvenient means, but it sounds like gas prices are up and the amount that they're getting paid for loads is not what it needs to be. So it's hard to justify it, or it's inconsistent in terms of like its ups and downs. Those would be my guesses. All right, so Teresa said, if I buy a 30-year, can I sell it at any time, or is it locked in for 30 years? This is one of the most common questions, because from the face value, if you bought a 30-year bond, you're thinking, okay, well, I got to keep that thing for 30 years. I might not even be around in 30 years. No, treasury bonds are one of the most liquid investments you can own. Whenever you want to sell it, it is easy to sell. You literally click a button and you sell it. Now, you can buy treasuries two different ways. You can buy them direct from the government. It's at treasurydirect.gov. We can put that up in the chat. Treasurydirect.gov.
Yeah, I've been posting it in there.
Okay, perfect. So Stephen's been putting it in there. You can buy direct treasuries there, but I don't do that. I want everything in my brokerage account. I have a Schwab and a TD Ameritrade account, which I hold no stocks in. I just want to be clear about that. But I own a lot of treasuries. But I buy treasuries I buy exposure to treasuries through ETFs. And I do it, there's two of them. And again, I want to be very crystal clear. This statement, I am not making a recommendation or a suggestion for you. I'm just telling you what I buy. I buy a ETF called TLT, and it's 20+ year treasury bonds. And I buy another one, which is ZROZ, Z-R-O-Z, which is 30-year zero coupon bonds. Now, if you bought ZROZ, one thing you got to understand is you don't get the cherry on top. So ZROZ doesn't have the cherry in the whipped cream, but it has a bigger fluctuation in price movement. Does that make sense? So we give up the cherry because you don't need the extra calories of the whipped cream anyway. So we give that up. And because of that, we get a much better tasting ice cream, okay? Because later the price moves bigger. But those are the two that I buy. And you can buy those in any brokerage account. If it's a 401k, a 457, I mean, we already talked, TSPs and governments are G fund. In most 401ks, they should, not all do, have some type of government bond fund or government bond money market fund. So you'd have to look, but a lot of 401ks I've seen recently don't have those. Sam said, you mentioned this morning about money not being safe in banks. Can you talk a bit more about FDIC insurance and why you should or should not trust that our money is safe? So, Sam, I'm not saying money's not safe in the banks, but I think we need to understand the risk right now with the banks. So let's just talk about safety with banks. Now, forget about what just happened with SVB, where the government came in and bailed out all depositors, when 97+% of the depositors of SVB had accounts more than 250,000. So you all know FDIC guarantees 250,000 or insures. I don't want to use the word guarantee. Insures your deposits up to 250,000. Does anyone have a calculator that can go into the trillions? Anyone? Can I have one volunteer from the audience? I need a calculator that goes into the trillions. All right, well, let's try this. First off, bank deposits. FDIC, 250,000 insured. Okay, we all know that. How much money does the FDIC have? Jordan, what was that number? Okay. The FDIC, you guys can look this up, has $128 billion. A lot of money, right? It's how much money the FDIC has. Look it up. Now, here's the math we want. All right, Michael, you got it, man. This is a big number. How much money do Americans have on deposit at banks? So this is just US, not worldwide. How much money do we have on deposit? Does anyone know? I do. And I don't know how to do the rest of the numbers. It's like 16 trillion. How do you do this? 16 trillion. I think it was like, we'll just do 368 billion, and we'll just do zeros. But all of you right away can figure this out. So what I need to do is, Michael, on your calculator, I just need you to put $16 trillion in your calculator. And then I want you to divide it by $250,000. I think that would be doing it right. Or actually, I think you would divide it by, yeah, let's do it this way. Scratch that, Michael. Put in 16 trillion and divide it by 128 billion. I mean, I think you all know just by looking at it, there ain't enough money. There's not even enough money, even close, in FDIC at 128 billion to cover even 250,000 of whatever the deposits are. It's not even close. So 1 trillion has 12 zeros. So 1, 2, 3, 4, 5, 6, 7, 8, 9. Wow. 10, 11, 12. There we go. Thank you. I don't usually just write checks for trillions of dollars, so I don't know how many zeros they're worth. I just know it's a lot. But all I'm trying to explain is right here, just in the simple math, you understand the problem, right? FDIC does not have enough money to back this, even at $250,000 per depositor. There's no way. Some of you are like, well, maybe somebody might have a lot more than that. The people that have big chunks of money, they're smarter. They don't keep their money in the bank, silly. They put their money in those specially designed and engineered whole life policies. I mean, just look up the Rockefellers and the Rothschilds and the Walt Disneys and the Ray Krocs. And, well, I don't know, you might as well look up Warren Buffett and, well, Biden, whatever you think of him, and McCain and JFK before, he was taken out. I mean, just look up those people. They all had money. They keep their money in whole life policies with giant mutually owned insurance companies. They don't keep their money in the bank. Right out of the hole, like, you can see the problem. So, Sam, to your question, that's the answer to your question. Now, should you worry about that? Only if there was a full-fledged run on the banks. Because the scary thing here, folks, is what we just witnessed happen. Over the weekend, the governors and the board of governors and all the big to-do people got together and they said, okay, we're gonna make sure that everybody's made whole from SVB. The FDIC is going to make sure that everybody from SVB is made whole, even though those depositors took extra risks. They knew it was only insured up to 250, but we're going to give everybody back their money. So now let's just understand what that decision just did. They set a precedence. So now they're saying that any bank that fails, they're going to bail all the depositors out. Please explain to me how that's possible. Oh, well, Chris, they'll just turn the printing press on and they'll print another $16 trillion. I don't think that's possible. Not in any way, shape, or form. So, Sam, you can take that for what it's worth. And all of you can take that for what it's worth. But if that right there doesn't let you know the farce, the lies, the smoke and mirrors that we've all been living under, and if that doesn't right there just help you finally understand that you've got to do something, you've got to take control of your money. You got to figure something out better than what they're telling you to do. I know they bailed SVB out, but they ain't going to bail out everybody. And they can't. And I'm not going to say there's going to be a run on the bank that takes down every bank, but there's going to be more bank failures. Mark my words, there's going to be more coming. And I don't know how they can keep it quiet. And I also don't know how they can keep bailing them out. But they did set the precedence. And that precedence to me says one very scary thing. The government is trying to nationalize the banking system. And I don't like the sound of that. I just don't. Teresa, let's see. Can I with my self-directed IRA? Sure, you can buy treasury bonds with your self-directed IRA. You can buy TLT, you could buy ZROS, you could probably, I don't think you can actually use your self-directed IRA to directly buy treasury bonds from the treasurydirect.gov. I don't think you would be able to, but you could definitely do the ETFs. James Davidson said, are you taking what would otherwise be PMC money you lend and redirecting to T-bills? No, not at all. I guess you would do that to hope that giving up some yield would. All right. So what James is asking is, he's asking, am I taking money away from my, I lend from my banking system, which is my policies, my system of whole life policies. That's how I lend money. I lend it to Robin Nicole Fuller. I lend it to Chris Rood. I lend it to other lenders on Private Money Club, which we'll hit in a second. I am not diverting any of that money to treasury bonds. What money is going to treasury bonds would just be money that I might have sitting around that, I'm not using, money that's in my brokerage accounts. I have money in a Schwab account that is an old 401k that I've got, some liquidity in that I didn't move to the self-directed IRA yet, primarily because I have a private REIT that I can't get out of yet. I don't have liquidity. So whatever money I have in there, I buy treasury bonds. And listen, I'm a saver. I really am. I mean, a lot of the money that I save, I put through my banking policies, but I still have money every single month sweep into my TD Ameritrade account. So that money, which is just probably, I'll be transparent, smidgen over $100,000 is all in treasury bonds, all of it, 100%. So it's not all of my money, but it's a chunk of it. Christy said, HELOC risk. Oh yeah. Stephen, should we talk about this a little bit? Should we stop paycheck parking, cash flow, paying down the debt, freezes coming? Wow, that's That's a loaded question.
Yeah, we can talk about HELOC risk.
So yeah, Christy, let me hit HELOCs. I'm not saying anything's wrong with HELOCs, but the one thing I think you all need to basically be aware of, okay, if you have a HELOC, if things continue to go south, there's a strong chance that banks, because of liquidity issues and everything else, will start freezing. And if real estate pricing keeps going down, they'll start lowering, and they'll start probably just closing some. A lot of people have a HELOC, but they haven't used the money. So let's just use a HELOC that you've got for $100,000, and it's the equity in your house. If you're not using that $100,000, that's fine. But if the bank decides they want to freeze it, you're done. So if they freeze it, you have none of your money available anymore. Okay, so if they freeze it, this 100 grand is not available. That's pretty clear. If they lower the amount, your 100 could turn into 50. And there's not a damn thing you can do about it because the bank's in control. And if they close it, you got access to no money. Okay, everybody understands all of that. So in the past, and I'll just go back to the pandemic, what I did is the HELOCs I had, and also HELOCs, right now rates are like 6. My mom's HELOC, I think, is like 9 or 6 to 9, but 6 to 9 is nothing when I can make 12 to 15% on Private Money Club. And actually, I saw something today. I just wanted to show you folks. So this is Private Money Club. I go here to go to deals. And, if any of you are members, you have access to this, but this little deal popped up, a $20,000 deal at 18.75%. I haven't looked at it, but obviously that caught my attention. So as long as it's first position, so this will be a 3-month hold with a rehab and sell with an expected ARV of 105. So you're lending 20 grand, technically saying 3 to 6 months after the initial funding, so yeah, that'd be worth getting a hold of Matthew Scott about. But just looking at 18.7, 5%, that's pretty darn good. And there's lots of deals like this. If we were to go and we were to look at more of them, there's 15% deals, 12%, 12%. This one I looked at, I like that one a lot. Let's see, what else we got? Micro loans, they do a lot of those. I don't know why we have a test deal on there. 36%, I don't feel like going into that one right now. 18% no brainer. I did that one last time. So I just want to quickly flash that because a lot of people hear these numbers and they don't believe that that's real, but it's incredibly real. So your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up. Getting back to HELOCs, I'm just going to make this bigger so you can see the screen. If you have a HELOC and the money's sitting there, yes, that money can be frozen, can be locked up. So what we did back during the pandemic is we got nervous about the bank freezing that. So I took all the money out of my HELOC and I spread it out in different bank accounts. Okay. So I took, if you got 100 grand, maybe you take 20, you put it in one bank, you take 50 in another, and you take 50, 60, 70, 30,000, you put it in the other. That's all 100. It's a cup game. So if you got a HELOC and you're worried about them freezing it, and you don't know where to lend that money or make that money go to work, we already talked about it. Even at 9%, if I'm making 18 minus 9, I'm still making a spread of 9%. So that's pretty darn good. Okay. So all I would suggest is if you're worried about your HELOC, just take the money out of the HELOC and spread it out among the about different banks. Play the shell game because the company or the bank where your HELOC is should have none of the money from your HELOC in it. Okay. So what I'm doing is I'm literally just taking all the HELOC money from, in my case, my HELOC's at KeyBank. So if I take the money from KeyBank and I put it into Alden State Bank, I put it into Cornerstone, which is a credit union, and I go over and I create an account at Evans. We'll just pick on, I think they got bought, but we'll just use that one. So what I've done now is I've taken my 100 grand from Key, I've gotten it out of KeyBank, and now I put pieces of it in 3 different banks. So even if they do want to freeze it, sorry, I don't know where your money is. We used it. I know exactly where all your money is. It's in these 3 different cups, right? There's your money, but you can't see it because I've hidden it. I've played the shell game. So we did this during the pandemic. I don't think we're quite at that point where you need to do it, but hey, you never can be too safe. So play the shell game with your HELOC money, or just get your HELOC money out to work. If you're not in Private Money Club already, we've sold out the March coaching, but we're going to then have the next round, which will be the May coaching sessions. So April will kind of just be fulfilling on March students, and then we'll have May will be the next one. Get into the coaching program, the accelerator, and we'll put that in the chat in just a second. Get into the accelerator, get yourself a membership to Private Money Club, and there's all the opportunities. All right, Ricardo said, do you know if TLT or ZROs are available in Fidelity? Yeah, as long as you have a Fidelity account that doesn't only allow you to do, and you could upgrade. Some Fidelity accounts only let you invest in Fidelity funds or Fidelity ETFs. And Fidelity has a treasury bond, but your Fidelity account should allow that. But just check it out, give them a call. Chris Ash, nationalizing the banks. Is this the next step toward the digital currency where the Fed can track every transaction you do and thus control your life? I think so. That'd be my simplest answer. I don't really have the knowledge to want to go deep into that, Chris, but I do feel deep down that there's a bigger picture here. And this is just the start of the way that they're going to push digital currency into existence, because they're going to start saying banks aren't safe and you can't control the banks. So we need to nationalize banking. Therefore, we need to control the money supply and the money situation. And that is digital currency. But again, way above and beyond the discussions for today. James said, had an option to put a line of credit on a rental property I have in Tennessee because of exactly what Chris is saying now. I opted to pay the points and origination fees instead and put a mortgage on the property because I did not want to experience exactly a reduction in the line of credit. Yeah, that's one way to do it, James. I mean, you could refinance, but you do pay all those fees and you reset the amortization clock. So now you're losing to the velocity of interest that the bank's getting. So, that could work. And then Gene said, any replay from today or from previous weekly presentations? Yes, they're all on my YouTube channel, every one of them. You just go to @the Chris Naugle. And can I ask a favor of all of you? We got 148 people on here. If you go to my YouTube channel, can you all make me a promise? Before I tell you this, before I even go any further, in the chat, can you all just say yes? I want you to make a promise to me. It's not going to cost you a penny. So Scott, yes, Blaine. Okay. So when you go to my YouTube channel, can you please not just go and watch my stuff? Can you actually subscribe to the channel? So we got 148 people. So any of you that go to my channel right now, all I want you to do is I want you to go to the Chris Naugle right at the top. You just type that in, okay, just like that. There's my little face. So you click the face and see this little button up here? It says subscribe, but yours would say unsubscribe. Can you please click that? Just click that. It'd mean the world to me. And then when you do that, there's also a little bell that comes up because I'm subscribed. It's not there, but can you click the bell so that every time I put a new video up, you would be notified of that video being up. So like when this video went up, you would have gotten a message saying, hey, a new video just posted, banks are collapsing. And that might be a topic you want. That's Gene's question about the previous ones, but please subscribe to the channel. And what about a demonstration of 250,000 FDIC coverage you explained with the 16 trillion divided by the 250,000? My calculator doesn't do 12 digits, so I can't do a demonstration. You could do it though, just do the math.
Yeah, it's silly. So we do have a good question, Chris.
Okay.
When you're ready for it.
Yeah, feds are bugging my system for sure.
I have a new mortgage, credit card debt, and student loan debt. I want to get started with the infinite banking policy. I don't have a lot of money to invest since it's mostly going to expenses and debt. Would it make sense to get started now with a policy or later when I make more money?
Well, I mean, I never like people waiting because you're giving up potential earnings. So even if it's a small amount, I want to bring you all back to a long time ago when I first started mine. My first policy was $230 a month. So, and why was it $230 a month? Well, because I had a big car payment. Well, not a big one, but to me, it was a big car payment. I had credit card debts. I had cell phone bills. I had other, debts on there. So all my money was going out, but I could save $230. And I'm really glad I did that policy then, because fast forward to now, that was 2004. So that was it's almost 20 years. It is 19 years. That was 19 years ago. You know how much that policy makes me now? If I put $1 into that policy, and I could figure it out, but I'm just going to guess, I probably make $3 for every dollar I put in. The alternative, Matt, would have been, I could have said, oh, I'm just going to wait. I'm going to work on paying off all these debts before I start saving over here. Listen, what I'd rather people do is start small over here. Like, just what is the number you know for a fact you could save every month in any situation, you know, and then just make sure that it's at least 10 times your age. So for me today, if I was in that situation, my bare minimum would be $450 a month. So I don't know how old you are, Matt, but let's just say you're 35, right? So that would be 350. The first question we would ask you is, can you save that much money a month? And can you do that no matter what? And if the answer is yes, then there's absolutely no reason to not start this. Now it's going to be slower, a slower growth. I know we throw big numbers around sometimes. We show policies with hundreds going in, but we also have case studies with people that do $100 or a couple $100 into their policy. Because what we would do is, in building a plan like this, we would organize all your debts, starting with probably your credit card debts, and we would put them from low to high. So low balance to high balance is how we would organize them. And then what we would do is, on a quarterly basis, the mapping team, implementation team, would set you up on a quarterly loan. So every quarter, we would take a loan from your policy, and then we would have that money come over and try to knock out one of these credit cards. And then whatever we save there. Now, here's another misconception a lot of people make. They think that they have to totally pay the credit card off to recapture. That is not correct. You all know how this works, so I feel silly even having to explain it, but I'm going to. If I have a credit card that I owe $1,000 on and I pay down $500, so let's just say Matt starts his policy with $350 and his first loan he can take out is $500, okay? Most people would be like, wow, that's not going to do anything. But let's say he's got a credit card over here that's $1,000 and we pay down $500 of that with the loan. Now he only owes $500. When he gets his next statement, do you think his monthly payment on that $500 is going to be less than it was on the $1,000? Yes. When I first started, I was in a really bad place. So that's how I did it. I literally set it up so that every quarter I took a loan. I don't care how much it was. It was a couple $100, and I would pay down the credit cards, not pay off, pay down the credit cards. I would wait 1 month, and then I would get the next credit card statement, and I still get paper statements, and I would look, and I would write it down on a little notepad, and I wrote it down. My monthly payment dropped by $20. So now I had $20 freed up that I then sent back to my policy as a loan repayment. So every month I had an extra 20 and I was saving $350. This $20 is $20 that you were giving to the credit card that you no longer owe the credit card. And then another quarter would go by, I'd take another $500 loan, or maybe it'd be a little bit more with interest. So maybe I could take $530 the next quarter, and then I would pay this credit card off. And now I didn't have $20, now I had $40, and I would move on to the next. And I did this over and over. Now I know that's a slow go. It's not exciting. It's not something that you're like, oh my God, you should see this unbelievable thing. It's like you picked up $40. You picked up $40 that you didn't have last month. That's a win, folks. Wins don't have to be thousands or tens of thousands or hundreds of thousands. Wins could be $10 extra a month, $20 extra a month, because that's a big win. That's money that you were giving away, folks. They were winning the game. Now you're winning. And it's a slow win. But you know what? The tortoise won the race, did it not? The rabbit never won the race. Even though it was faster, even though it could easily win, you saw the children's stories. The tortoise always wins. And you're the tortoise, you always win.
And Chris, let me add to that a little bit, because I always ask, like, when I'm presenting this in a big group or something, like, I'll just ask people, like, are you important? Like, are you important to yourself? Are you an important person in your life? Like, do you matter? Like, should your family matter? And, so many people just, all their money goes out to everybody else before they ever consider themselves. I mean, if you just take like an average dollar bill right here, this is how people spend money. So they get paid a paycheck, and as soon as they get that paycheck, it starts going out to everybody else. So you have, if you take $1 on average, 20 cents of that dollar goes towards automobiles, as an example. 30 cents of every dollar that you make goes towards housing in like a mortgage or rent or insurance or whatever the case is. 40 cents of every dollar that you make goes to everything else. So kids and travel and food and entertainment and all that stuff. So for the average person, it leaves them, if they're lucky, if everything goes right, with 10 cents of every dollar that they earn is what might go into their savings, into that little bucket over there. But if an emergency, a car breaks down, you needed something in your house, or your kid needs braces or a dental, or my son just had a cavity. Those are even crazy, stupid, expensive. But anyways, all that savings could go out the window and all of a sudden it's gone. But if you're important, what we need to do is we need to take that same dollar, but do it backwards. So what we want to do is we want to pay ourselves first. We want to take that dollar that we earn and we want to put that into our own savings or our own bank, because by putting it in there first, now when these emergencies happen, we can take it from our bank to pay for those expenses. And by taking it from our bank, now it's within our financial lives still, because it's continuously compounding instead of it being gone forever or losing or paying interest to somebody else. So everything else is the same. But what that allows us to do is, for example, 5 cents of every dollar, or of every 20 cents that goes towards an automobile, a car payment, that 5 cents goes to interest on average. So by paying ourselves first, using a car as an example, we now can purchase cars through our banking system, allowing us to keep all of that interest. See, we're still going to pay the interest on it. That's the key. You're still going to pay the interest, but are you going to give that interest to BMW or Toyota or Honda? Or are you going to give that interest to your banking system for you and your family? And that's the difference. So by paying ourselves first, we can now recapture that interest, which is just going to go into our savings, our banking system, and take our annual savings. It's going to increase it by 50% by doing that one thing right there. Because I was saving 10 cents before, now I'm saving an extra 5 cents a year. That's a 50% increase. And then we can take that and we can show it, using for housing. What's that look like when we're recapturing the interest? All the other interest that we're bleeding out in student loans and everything else. What if we recapture all that money as well? And that's how you start snowballing it on top of what Chris was showing with that whole snowball method of paying down debt. So I just want to throw that example out real fast, Chris.
I love that example, Stephen. And, I don't do it from stage anymore, and I should. And it's just because sometimes I just didn't feel like it got to the point fast enough, but that is the point. And I love what Matt was just saying. And I love what you just said. Listen, so much of what we teach folks is mindset. And, I know it's cliche, it's just a word, but it is. It's like the only difficult clients we ever have are the ones that are not willing to change their mindset. It's a mindset problem, because we're teaching you how to do everything backwards from what you've been taught. But what you've been taught hasn't really worked. And some people would be like, no, it's worked just fine. Well, no, not really, because you've always given your control away. This is teaching you how to take back control, teaching you how to be the bank, because what we just showed Matt, what Stephen just showed, every bit of that is exactly this. It's just taking control back. And it doesn't matter how long it takes. Listen, I don't care how much money you start with. I don't care how much money you take back. $40, $20, whatever it is, that's you starting the process of changing your mindset. And I'll promise you, I am living proof. Stephen's living proof. Sean is living proof. Once you start this, you will never, ever go back. You will never go back. The only way you'll go back is if you don't learn it from the get-go and you don't do it. Here's where you're going to make the mistake. And folks, I'm going to be very clear about something, and I don't think I've said this publicly. One thing my entire team is starting to be trained on and coached on by me is not figuring out who our clients are and like trying to get more clients. It's figuring out who our clients are not. You want me to explain why? We've got hundreds upon hundreds of people who have started the process with us, who have gotten to the finish line, and their policies are issued and ready for them. And they're dodging us. They're not taking our calls. These are people I know. I just called a guy today that I spoke at his event. He's dodging me. He's literally not taking my calls, not responding to my text messages. So I am now starting the process of figuring out who we're not going to work with. You know who we're not going to work with? We're not going to work with people that when we get them on the phone, the biggest, most important thing that they want to learn about and they want to go into the weeds about is the policy. Because nothing about what Stephen just explained revolves around the policy being the single solitary thing that makes this all work. Everything Stephen just explained is the process of moving your money and taking back control of your money. Yes, the policy gives you a little tailwind behind your money. Your policy gives you a little spread. Yes, your policy gives you a death benefit and some tax-free growth. But seriously, like, This is not the Holy Grail. The process, the infinite banking concept, that's the Holy Grail. So when I get somebody on the phone, or any of my team gets somebody on the phone, and all they want to know about is the policy, and they don't want to learn the process. They just want to, oh, the policy, the policy, the policy. How much does it pay? How much is the interest rate? What's the guaranteed rate? What's the dividend? How much money is the illustration? Can you run this illustration and that illustration? I'm sorry, sir. Hang on a second. Let's just pause right now. Do you understand what it is we do? Well, yeah, you guys sell policies. Wrong. We don't. We teach a process, a very important process of taking back control of your money. And it's a banking process. We teach you how to be the bank. Oh, yeah, that BYOB thing. Yeah, so back to the policy. No. Back to the process, sir. It's the process that's going to change your life. It's the process that's going to make you wealthy. It's the process that's going to keep you wealthy. If you want to buy a policy, let me give you someone else's name, because that isn't us. It isn't us. It's somebody else. We'll set your policy up, but please understand this process is what we care about. The policy just makes your money work a little more efficiently. So that's a really important thing. And that all comes back to that mindset. Everything Stephen just showed with that dollar bill is a process, not a policy.
No, as I say, to your point on that, I mean, when I get on the phone with somebody and they immediately start asking about the policy, I'll quickly reverse it on them and start talking about the process and infinite banking and the concept. And then the more I get into that side, the more I realize they don't understand the concept and the process, and they're just reverting to asking about the policy because that's all they know to ask about. They don't know the questions to ask about the process or the concept. And that goes back to your Will Rogers quote: the problem in America isn't what people think they know, isn't what people don't know, it's what people think they know that just ain't so. So they're just reverting back to that mindset again. And so, like, Matt said he's read 10 books this month between Audible and reading. I mean, you look at my shelf behind me, I mean, all the most powerful books when it comes to this concept, money, finances. There's a reason why we do this kind of thing, because a lot of it is mindset. Why? Because we're hammered our entire lives to think one way. A 401k, diversity, mutual funds, track it, all this stuff, and it just doesn't work. And so that's why that's so important to stay around the right people. Webinars like this, live events. We have a workshop coming up, masterminds, all this different stuff. The money tank. How about the money tank, Chris? Stuff like that is so very important. But so I love it. And Katie brought up a good one real fast. Katie said, Chris, can you give an example of a young 18-year-old starting out? They don't have debt at that age. They would use the policy to just start saving, correct? But real fast before you answer that, here's the beautiful thing about 18 years old. You're young. This entire concept works really off of compounding interest. So compounding interest works off of time. You said it a second ago. This isn't get rich quick. This is get rich in a process. It takes time, but if you follow it, it will happen. So an 18-year-old versus a 48-year-old, they have an extra 30 years on the person that money's going to sit in there and compound, meaning they can put smaller amounts in now. And when they get to 48 years old, how far ahead are they going to be than that person at 48 now that never started this at 18? It's mind blowing, especially when you look at kids, like you look at Vivi's policy, my son Bryce's policies. These things are so unbelievable. It's the same with an 18-year-old.
Yeah. I mean, this is Vivi's policy. I show this all the time, but I mean, this is time. This is nothing exciting in the first 5 years, probably not even exciting by all intents and purposes in the first 10 years. But after that, this thing's super freaking exciting. I mean, right here, just from year 11 to 12, the thing grows almost by $10,000 and we only put 5 in. That's exciting. And it just keeps going. And, a lot of people are like, well, stock market can do the same thing. No, it can't. The stock market goes up, down, sideways, goes all different directions. These only go one direction, one way. But again, back to the main thing we're talking about, it's this process. And I don't know who said it. They said it's habitual. Once you start mastering the process, once you master this flow of money, I don't care if it's paying off debt, buying cars, lending money, buying real estate. Once you start doing it this way, you don't know any other way. Like if somebody came to me and tried saying, oh, the way you're doing that's all wrong, I'm like, no way. It's not. You could never, ever get me to go back to the other way of doing it, ever, because I know the math, I know the numbers, and I know what it's done for me. You see, the check that I get every single month that comes back to my policy, it's my money. And that's what people argue. People that don't understand this, that haven't learned the process, they say, well, it's still your money. Well, your car payment, that was your money. You paid the car off. So why would you make a car payment back to your policy? Because I made a car payment to somebody else's bank for the majority of my life. Now I make a car payment to my bank, my policy, and I get all the money back for every car I ever buy, drive, and own. And I don't even have to sell the darn car. If I sell the car, That's the whipped cream and the cherry on top. It's all a bonus. And if that is something people can understand, that simple one thing I just explained, that, you know, they can't get over the fact it's my money. It's my money. Why? I paid the car off with my money. I paid the credit card off with my money. Why would I pay it back to myself? Why would I keep making a payment? If that's how you view it, move on. Keep going. Don't even stop here. Like, nothing to see here. Keep going. Because like that right there is a serious mental block that someone has to get around. We can teach you everything you need to know about money, but we can't change your mind for you. You have to do that. And I think that's the single biggest, most important thing people need to understand. There is no possible way this doesn't work. There's no way it doesn't work. It works 100% of the time. The stock market doesn't work 100% of the time. Your 401k works about 1% of the time. This works 100% of the time. But where it goes off the rails is when you stop being an honest banker. When you start stealing from your bank, it's game over. Like, it's just not going to work. When people start taking loans out and then they come up with excuses not to pay their bank back. Oh, this happened or that happened, or oh, we hit hard times. Oh, I needed the money for this. You're stealing from your bank, and your bank will go out of business, just like SVB. Just remember, the policy, forget about it. You're creating a banking system, and a banking system relies on you being an honest banker. That's it. You know, every business relies on you being an honest business owner. You don't steal from your business, or your business goes out of business. And not only that, if you start stealing from your business, your employees will then start stealing, because you lead by example. So do you want to lead and run your bank when all your other people that surround you that are looking for you as the leader of this bank, and they watch you steal from your bank? Do you want them to start stealing from your bank? Because they will. You got to lead from the front, like wolves. The alpha wolf's always out front, always. Never in the back where it's easy. They're always out front doing the hard work. But because of that, they've done amazing things. I mean, just look at wolves. I mean, they're just incredible what they can survive. I don't know why I went down the wolf rabbit hole, but it's a process that we teach. The policy is just a better machine to run our money through. It's a better machine because it's always been a better machine. I don't really need to put it anymore. We're talking about specially designed whole life. To be crystal clear for anyone new, we're not talking about IULs. They do not work for the infinite banking policies or for the infinite banking concept at all. Because wolves eat rabbits. Oh, wow. Can I just pause for a second? And this is off topic. I'm just going to put me and Steven up. I got to tell a story. I read this. I think I read it on Facebook. It was wild. So there's a donkey and there's a lion. Okay. And the donkey comes up to the lion and starts arguing with the lion. And the argument was about the grass. The donkey told the lion, you know, isn't this purple grass beautiful? And the lion looked at the grass and he said, donkey, the grass is green. And the donkey said, no, it's purple. And they bickered back and forth, and it turned into a dispute. And the donkey went to the leader of the land, we'll just call this the court system, and filed a suit or filed a complaint against the lion. And they both went to court, and they both stated their arguments in front of the leader, okay, the lead lion, we'll just put it, the ruler, and you can see where this is going. And they both stated their point. The donkey's going on and how the grass is purple, and can't everybody see the grass is purple? Jury, look at the grass is purple. And the lion's like, are you all mad? The grass is green. Look at it. It's green. You can't argue that it's green. At the end of this whole dispute, the leader of the land, the king lion, ruled against the lion. And the punishment for the lion was the lion could not speak for a year, and it had to do a bunch of other things. So the lion lost, and the donkey was so excited. See, I told you the grass is purple. The grass is purple. I knew I was right. You're an idiot. You're wrong. And the lion, dumbfounded, goes up to the leader at the end and says, King, you know the grass is green. And the king looks back at the lion that he just punished, and he said, of course it's green. And the lion's just like, oh my God, why did you find me guilty? And he says, I found you guilty because you're a lion arguing with a donkey about the color of the grass. You are guilty because you spent the time and the energy to waste my time and everybody else's time arguing something so stupid. Why would you argue with a donkey, folks? When someone can't see the truth in front of their face that you have laid out to them, don't argue with them anymore. There's a lot of other stories about that, but like, think about that. You are all the lion. Like, don't argue with donkeys. Don't argue with people that IULs are better or worse, just dismiss it. Okay, that's your opinion. I know I do, but hey, I like a little bit of a fight. But at a certain point, you just got to know where you stand. And I think that's a really important lesson that we can get out of that. So Gene, and I probably butchered the story, Gene said, how can everybody benefit from current turmoil we have come through in the last couple of years? I am hoping now is going to be the biggest transfer of wealth leads into. How can everyone get started having an initial savings to get started putting? All right. So Gene, I guess the first thing I would tell you to do is on my YouTube channel, I know you're already subscribed, but watch my TEDx talk. It's called Rethink Money, a Letter to My Daughter. Please watch that. You can just Google Rethink Money, Letter to My Daughter, or TEDx talk, however you want to put it in there, and listen to that, because what you're asking is, how can everybody get started? You get started by understanding the process and the laws of wealth. First, you must save money. If you're not saving money, that's where you start. And you don't go any further until you're saving money. You should be saving minimum 10% of the money you make. Now, a lot of people are like, why do I can't, I'm living paycheck to paycheck. Okay. I'm not going to argue with you, donkey. Get a second job. Okay. Because I'm the lion, you're the donkey. And you can take that out of context, but you get it, right?
Hold on real fast. Hold on, Chris. I would not tell someone to go get a second job. Learn business, learn entrepreneurship, learn how to control your income, control your wealth, control your profit, control your life. And you do that, in my opinion, the number one best way to do that is through real estate. And so if you don't have a lot of money, but you're willing to hustle and get your ass out there and make things happen, learn wholesale real estate and learn short sales and foreclosures. In this market we have coming right now, that will put you above everybody else. If you understand foreclosures and short sales and how you can take advantage of that, and distressed properties, there's gonna be a lot of people in trouble. Distressed properties, go in, negotiate, get these properties under control through wholesale contracts and feed them to the big players right now. Do that and you will make money. Then take that extra money you're making and be smart with it. Put it into things like infinite banking concept. Put it into things like Roth IRAs. Be smart with the money and continue to invest and grow your wealth. So that's how you set yourself up, through education, through books, Audible, webinars, coming to events, masterminds, learn from people like us, and then getting out there and hustling. I don't care if you sleep 4 hours a night, whatever it takes, put yourself in a position, because you're absolutely right. This will be the largest wealth transfer in our lifetime coming up. And those that are ready for it are going to be good to go. So that's all I got.
Well said. And, sometimes I say get a second job or a side hustle like you just did. I don't know. Sometimes, like, when people say they're living paycheck to paycheck, it's like, well, go out and do what everybody else is unwilling to do to get yourself out of that situation. Right. There's no easy path. Thanks for setting me straight. Sometimes I go off on my tangents. Let's see, list of top 5 books to change your stinking thinking. Think and Grow Rich would be top of that list. Think and Grow Rich, then listen to Earl Nightingale's The Strangest Secret in the World. Then, and it's not a book. Well, there is a book on that, but you could just watch the video. What other books do you think?
Let me read my Becoming Your Own Banker by R. Nelson Nash, Mapping Out the Millionaire Mystery by Chris Naugle and Brent Kessler, Rich Dad, Poor Dad by Robert Kiyosaki, Second Chance by Robert Kiyosaki, Money Master the Game by Tony Robbins, The And Asset by Caleb Gilliams. Those are all great books to start with on different mindset and banking topics.
All right. Antonio said, will it be okay to pull out my 403B and take the loss on the taxes for pulling out early and dump it into a policy, or is there a backdoor rollover? I don't love when people want to take their money out of their 401ks or 403Bs. I'd much rather you roll it into a self-directed IRA and become your own bank using that mechanism, because then you don't pay the government taxes and penalties on money that you could avoid. So I would say probably the best thing. And Stephen, I had somebody earlier give their number. Can you just put your link up so people can set up a call for the infinite banking concept and they can get on a call? And I think, Antonio, that might be a good one for you to kind of just have us learn a little bit more about you and why and what you're doing. I mean, I'm not saying it's always a no when you're talking about canceling your 401k, but usually there's a better solution so that you don't have to pay penalties. So right there, Stephen just put up his link. Just go on there and do that. Now, for the last couple minutes, what I'd love to talk about is something something we'd like to invite all of you to. And we've got I wish the page was ready. We can put it up. Actually, I'll put it up right now. But this page is getting completely revamped. We came up with the coolest little thing. Stephen had this idea. since all of you probably know Think Tank or Shark Tank, we came up with Money Tank, and we came up with a really cool logo. I can't show it because it's on my phone, but maybe Steven can. And I just made one change to the logo, and I added Cash, my kitty cat. Where is he? But I added him to the tank. So this is going to be our new theme for all of our Private Money Club workshops. And we'd love to invite every single one of you to the next workshop. It's April 25th, 26th, or I'm sorry, not 25th, 28th to the 29th. There it is. So that's the new logo for our workshops. And we're going to be running with this. It's called Money Tank. So we would love to invite all of you out to Utah for the first of what will be 3 Private Money Club events that we're doing this year. I'll put the link in the right here. And I think we might even have a special offer for everybody. Steven, are we doing that today?
Yeah, give me a second.
So we just came up with this yesterday, and this is only for all of you, okay? So we're going to be very reserved about how many people we offer this to, but because you're our clan and we got a bunch of you here, we wanted to make this special offer. And this is the first time we're really making the offer, but we wanted to give you 50% off. So 50% off the first Money Tank event, April 28th and 29th. It'll be in Utah. We have general admission tickets and VIP tickets. The VIP tickets get you special networking. We're going to go race go-karts as a group networking. Go ahead, Steve.
If you go to the site right now, just keep it up and ready, and keep that code right there ready, like save it in your phone or something, or write it down. When you check out right now, there's not a place to put a discount code, but they're updating that right now. It should be done at some point today. So if you want to pay full price, go ahead and buy now. But if you want half price, use that code. Just give us like maybe an hour or 2 or so.
Yeah. We're just in the process of updating it. And we literally came up with this yesterday. Me and Robert Sislo came up with that tank logo. I don't know, what time was that? Me and you were texting last night, 9 o'clock?
Like 9 o'clock or so. Yeah. And here's the thing too, the website right now, if you go to that Private Money Club /workshop, it's just like bare, like nothing's really on there. There's no details. So once we get the site like done later this week, the half price, we're not going to be using it. So we're just kind of saying, hey, if you want to buy now before things are really ready, get your ticket. You're good to go. We love you guys for being here. But do it because it's going to go away.
Absolutely. Yeah. And it's going to be a really amazing event. You can go to that link and you can see a little bit about it. The link is going to be all revamped soon too. But VIP, if you want to do the VIP, you're going to fly in the night before, the day before, and we're doing a really special thing called the Vibe. And if any of you know who Sean Whalen is, he's gotten pretty big. So Sean Whalen's going to be there. You're going to get to meet him. We're going to be doing a Q&A. So Kelly Cardenas, which many of you know or have seen on our show, he's going to be interviewing Sean Whalen. He's going to be interviewing me and a couple others. And it's going to be a very small, unique event for the VIP members and a couple, guests that we invite. So that's something. And then, after day 1, we're going to do a networking event. It's only for VIP members where we're actually going to go, I think this isn't locked in stone, but I think we're going to go race go-karts, network, and have a good time. And if it's not go-karts, we're going to be going over to an energy drink company, and we're going to be basically networking there. So it's going to be one of those 2 things. It's going to be a lot of fun. But yes, 50% off. And yeah, John, Lions Not Sheep, Sean Whalen. That's the one. So grab your tickets, and because you guys are the early adopters, we got that special code right there that was made just for Wealth Webinar folks. So let's see, Kira, if I said that right. Question: we have a policy with One America that we just set up, but I was just recently told that it's better to sell off the policy at the end versus letting it pay out the death benefit on graduation day, because they said all the cash value goes to the insurance company and the only death benefit payout is given to your family members. That is not true at all. Hang on, I think I can just prove it to you. Who told you that, first off, Kira? So you got a policy with One America. We set that policy up, and who the heck told you that? Because that isn't true at all. As you're making premium deposits over the years and as you're earning uninterrupted compound interest, the death benefit and the cash value are going up simultaneously. So as the cash value goes up, your death benefit goes up. So when they're saying that all your cash value just goes back to the insurance company, that's silly. Your death benefit along with your cash value have been rising through paid up additions. And sorry, I feel like I'm I'm doing this like workout thing here.
I got one. I'll pull it up, Chris. I just want to delete
Okay,
their name real fast. Give
I
me 2 seconds.
finally got it. Yeah. So what, yeah, let's let Stephen pull it up. Sorry. I spent all that time pulling this thing up, but yeah, pull yours up. That'll be better.
All right.
Not anyone through your company, acquaintance who recently got licensed as a life insurance agent. You should have done your policy through us. I bet I'd like to review that for you, Kira, to make sure that it's even done right, because it sounds like they're not using paid up additions if that's the case. Didn't make any sense to me because I know your projection table shows. All right, Stephen, walk Kira through this illustration and show her how that works.
Yeah, I mean, a couple of things. So on the far right, the left side right here, we have the policy year. So how long you've had it for, the age of the individual. This was a 43-year-old male. So you can see it shows right through, 77. I could keep scrolling to show you the rest of it. But cash value, we have total net cash value right here, and then we have total net death benefits. So you can see in the early years, 43 to 123,000 in cash value available. Remember, the cash value is the amount that you have available to pull out to use, even while all the money's in there compounding. So over on the right-hand side, the death benefit's way ahead, as you can see. Now, something I'll point out, since this happens in a lot of policies, they did a dump in. So they did 50,000 the first year, and then 20,000 a year after that. And then starting the 11th year, just under $5,000 a year. So you'll see, because of this dump in and the very high cash value we created for this individual, so they could access more of their money quickly, this death benefit is higher in the first 10 years. The reason for that is because there's IRS rules and regulations, 7702, that we have to operate within, that tell us for basically every amount of cash value has to be a certain amount of death benefit, or else it'll what's called MEC the policy. So we want to keep this a life insurance contract, not a modified endowment contract, because a life insurance contract gives us tax-free growth, tax-free loans, protections from debtors and creditors, the tax-free death benefit, everything, all the benefits we get from a whole life policy. And so we build a little bit of short-term term into this thing, into it, to avoid it from necking. But as soon as we can get rid of that term, we drop it off of the policy, because it's just drag. There's no efficiency for banking purposes. And we're doing this for banking, don't forget. So that's why you see that death benefit fall off. But even when it falls off, look how large the death benefit is and how it continues to grow every year compared to the cash value. So even when this person's 77 years old, 35 years into the policy, they have $800,000 in cash value available, and they have $1.1 million in tax-free death benefit. So unless you can sell the policy for more than that, this 1.1 million is going to be higher, and it's going to pay out tax-free as well. So I don't really understand how somebody could say that would happen.
I think Kira nailed it. It was somebody that she knows that recently became an agent, so they just don't understand in practice how it works. But like how you saw that, I mean, every time money was put in, whether it's the dump in or just the premium deposits, the death benefit went up. Yes, I know we dropped the term in the 10th year, so the death benefit dropped, but did you notice how it regrew itself back up over $1 million? All policies will do that. So
here's the rest of it. This is the next, 30 years.
Yeah, I mean, look at this. So like, the average, I know we can never predict what's going to happen, but from age 80 to age 90, that's a pretty good chance. So look at your death benefit goes from 1.2, and when you're 90, it's 1.4, if I'm following that over correctly. So you can see the reason that goes up is because your cash value is going up. So as your cash value goes up, your death benefit goes up. The two work, in conjunction. And actually, if we were to go to 121 years old, which is the next page, you'll see at 121, the cash value and the death benefit meet each other. And if you make it to 121, if you're lucky enough, the insurance company will just mail you a check for the death benefit. And I don't know what you're going to do with it at 121, but there you go. So this person, if they make it to 121, they're going to get a check for $2.6 million.
Yep. See, that's when it took. Yep, the cash value finally went above the death benefit.
There you go. And that's what they call that an endowment. And that's where your policy just endows, and now you get a big check. And because we're at the end here, I'm going to answer this one final question. Jean said, what's the best suggestion on how to go about buying gold, silver, or Bitcoin? Well, if it's Bitcoin, you should probably bring Spencer onto your team and go through his trainings to learn how to properly play the Bitcoin game right now. Who would you recommend for the following in a nutshell? Wanting a trustworthy source, where do I start? So Stephen, I'm going to let answer the gold and silver. When, now, yes. My question in a nutshell. Who would you recommend to follow? I mean, not selfishly, but us. I mean, we talk about all these things. Bitcoin, we bring Spencer in because he's the expert. I don't know if we have his number. We can put it in the chat. But Stephen,
we talk about gold and silver all the time. We bring Spencer under our 3 days. Join us for the next 3 day, Gene. It sounds like you really need it, and it'll be a life-changing 3 day weekend for you.
Yeah,
100%.
For sure. All right. Well, we covered a lot of ground. I hope that was good. I'm sorry I told, people to get a second job. Thank you for correcting me, Stephen. But, sometimes we got to just do the hard work. And that's what I've had to do. So sometimes I'm a bit harsh and rash about my actions and what I say. But deep down, we care. We care about all of you. We care about your success. And we certainly care about you taking back control of your money by you becoming your own bank. So I hope to see a lot of you at the workshop, or what we're calling the Money Tank. And that will be April 28th through the 29th. There's the link for it. So get your tickets today for 50% off. Oh gosh, I don't have time, Ricardo, to hit that. And Ricardo and anybody else that has additional questions, join us this afternoon at 4:30. So a short 2 hours from now, we're going to do an Ask Me Anything happy hour. So myself and a lot of our team will come on and we'll answer all your questions. We definitely can dive into the difference between IUL and whole life. But I think probably one thing I can give you, while we're waiting here, is just give you a video. Because I got a whole bunch of videos on IULs on my YouTube channel. So you can just kind of watch any of them. One of my favorite is the one I did with Devin. It's a good one to watch because he's severely hungover. So if you really look at him, it's super funny. But we really go deep into his IUL policies and how he got taken down that wrong path. So there you go. But also join us at 4:30 versus whole life. And there's a whole bunch of them. All right. With that being said, thanks everybody for joining us on another wealth webinar. We'll see you this afternoon at the Ask Me Anything. All right. So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.